So you've probably heard the term options trading thrown around, right? And if you're like most people, it sounds, well, incredibly complicated. But what if I told you it doesn't have to be? In just the next few minutes, we're going to pull back the curtain and break down exactly what options are, step by step.
And hey, let's be real, you are not alone. This is one of the most common questions you see online. Our whole goal here today is to answer that exact question, in plain English, with no confusing jargon.
So let's dive in. What exactly are stock options? Before we get into any of the technical stuff, let's just forget all that for a second. We're going to start with a really simple analogy that's going to make this whole thing click.
Okay, so imagine this. There's a hot new toy coming out. Instead of buying the toy itself, you buy a special ticket. This ticket gives you the choice to buy that toy at today's price anytime in the next month. Now that word right there, choice, that is the absolute key. You have the right, but not the obligation to buy it. If the toy's price goes through the roof, awesome. You use your ticket to buy it cheap. But if the toy turns out to be a dud, no problem. You just let the ticket expire. The only thing you lost was the small fee you paid for the ticket. That's it. That's the core idea of an option.
Okay, so basically, all options boil down to just two types, calls and puts. A call option is like that ticket we just talked about. It gives you the right to buy a stock. You'd buy a call if you're bullish, meaning you think the stock's price is going to go up. A put option is the total opposite. It gives you the right to sell a stock. You'd buy a put if you're bearish, if you think the price is setting down. So just remember, calls for up, puts for down. That's the first big piece of the puzzle. All right, let's get just a little more technical for a second. The official definition of a call option is a contract that gives you the right, but not the obligation, to buy a specific number of shares at a locked-in price by a specific date. And one super important detail, one options contract almost always controls 100 shares of the stock. This is your bullish bet.
And then you have the put option, which is, well, it's the exact opposite. It's a contract giving you the right to sell 100 shares at a price you agree on today. This is your bearish play. It's how you can potentially profit when a stock price falls.
Okay, so I know what you're thinking. Why would I mess with this? Why not just buy the stock if I think it's going up? And that is a great question. Well, it turns out that options give you a few, let's call them financial superpowers that you just don't get with regular stock trading. There are three big ones. First up, you get this incredible thing called leverage. You can control a huge chunk of stock, say 100 shares worth $10,000 for just a few $100. Second, you can actually generate income. You can sell options on stocks you already own and create a new stream of cash flow. And third, you can use them for protection. It's kind of like buying insurance for your stocks. You can use a put option to protect your portfolio from a big drop.
All right, if you're going to trade options, you have to know how to read the map. And in the world of options, that map is called an options chain. Now, I know it can look super intimidating at first, but it's really just a big table with a few key pieces of information you need to understand.
The first thing you'll see is the strike price. Think of this as the anchor for the whole deal. It's the price that's written on your special ticket. It's that pre-agreed price where you get the right to either buy the stock or sell the stock.
Next up, and you really got to pay attention to this one, is the expiration date. This is so important. See, unlike stocks which you can hold forever, options have a shelf life. That ticket you bought is only good for a certain amount of time. If the stock doesn't do what you thought it would by that date, your option can expire completely worthless.
And finally, there's the premium. This is just the price you pay for the option contract. But, and listen up because this trips up everybody at first, the price you see listed is on a per-share basis. And since one contract controls 100 shares, you always have to multiply that premium by 100. So if you see a premium of $2, that contract is actually going to cost you $200. Don't forget that.
So you'll hear these terms thrown around, in the money and out of the money. This table breaks it down, but it's actually pretty simple. For a call option, if the stock's price is already above your strike price, your option has value. You're in the money. For a put, it's the opposite. You're in the money if the stock's price is below your strike. Out of the money just means the stock hasn't moved enough yet to make your option profitable.
All right, enough theory. We've covered the what, the why, and the lingo. Now let's talk about how you can actually use this stuff. We're going to look at two of the most popular strategies for beginners, and both of them are focused on generating income. Let's start with strategy number 1, the covered call. This is a favorite for a reason. It's a fantastic strategy for anyone who already owns stocks and wants to make a little extra cash from those shares they're holding. It's a really simple 3-step process. First, you have to own at least 100 shares of a stock. That's the covered part.
Then you sell one call option against those shares. And for doing that, you immediately get paid a premium. That cash goes right into your account and it's yours to keep, no matter what happens next.
All right, strategy number 2 is the cash secured put. This one is super clever because it gives you 2 potential ways to win. You can use it to generate income, or you can use it to buy a stock you want anyway, but at a discount.
So here's the game plan. You find a stock you'd be happy to own, and you pick a price below where it's currently trading. Then you sell a put option at that price. Right away, you collect the premium. Now, one of 2 things happens. If the stock stays above your price, the option expires and you just keep the cash. Awesome. If the stock drops below your price, you have to buy the 100 shares, but you get to buy them at the lower price you wanted in the first place. See, you either get paid to wait or you get to buy a stock you wanted anyway at a discount. Pretty cool, right?
Okay, now we've talked about all the cool things you can do, but we have to talk about the risks, because with that superpower of leverage comes the potential for really big losses, especially if you fall into this one classic beginner trap.
So what is that number 1 account-destroying mistake that so many new traders make? It's this, plain and simple, trading without a plan. Look, the whole point of having a trading plan is to take emotion out of the equation. When you let fear and greed drive your decisions, you're going to make mistakes. You'll take bets that are way too big, or you'll panic and sell at the worst possible time. A plan is your defense against that.
And look, a plan doesn't need to be some 100-page document. It just means you've thought through these basic questions before you click the buy button. How much money are you comfortable losing on this one trade? What signals are you looking for to get in? And, this is the most important part, what's your exit strategy? When do you take profits? When do you cut your losses? Answering these questions is what separates disciplined traders from gamblers. So that brings us to the big question, the one that really matters. After all this, what's the verdict? Are options a sophisticated, powerful tool for building wealth? Or are they just a high-stakes, Las Vegas-style gamble? And you know what? The answer is that they can be both. The tool is the same, it's how you use it that makes all the difference. And that all comes down to your plan. So if you're ready to take the next step and learn about a powerful strategy that combines everything we talked about today, check out our next explainer on the wheel strategy. Thanks for watching, and if this helped you out, do me a favor and hit that subscribe button. We'll see you in the next one.